Good morning, everybody. This is Martin, your mortgage guy in Birmingham, Alabama. Mortgage license number 1034611. And I should say that the views represented in this video are not necessarily the views of Valley Bank or any other company that I may be employed by. I want to talk today about the Fed meeting, the Federal Reserve Board, or the Federal Board of Governors Committee. They are policymakers that are given the job by the United States government. I guess that means by Congress. Their job is to regulate the economy, to keep the economy stable. And so it's always big news whenever the Fed is meeting and doing something with interest rates. So what I want to talk about today is Fed Day. That means there will be a press conference today at 2 p.m. Eastern after the Fed has been meeting yesterday and today, and they will announce what their decisions are after their review of recent economic statistics, whether they will maintain the current overnight interest rate, that is the rate that banks charge one another when a bank borrows money from another bank. So that is what the Federal Reserve Board regulates. That is what they have control over. It is what we refer to as the prime rate, or the overnight bank rate. And so what that directly has impact on is those rates, the prime rate, you will see whenever you take out a credit card. You look at your credit card statement and see what the rate is. Look at maybe vehicle loans, look at for sure personal loans from banks and home equity lines of credit, especially these types of revolving credit like equity lines and credit cards that have a variable interest rate. Those are based on the prime rate, or the bank overnight rate. They're usually the prime rate plus what we call a certain margin. So when you hear that the Fed is raising interest rates or lowering interest rates, that does not necessarily directly have an impact on mortgage interest rates. So there's always some confusion around that. If the Fed today lowers interest rates by 0.25% or 0.50%, that does not have a direct impact on mortgage interest rates. Mortgage interest rates are determined by the bond market. That is the value of federal bonds. So when bonds are more valuable, then interest rates can be lower on mortgages. So that's mortgage-backed securities, these bonds that are basically thousands of mortgages bundled together. They have certain value. When the value is higher and they're selling for more, then interest rates can be lower. And then the opposite is true. So that's a little bit about the Fed, what the Fed may be doing today, and how that impacts mortgage rates. So the bond market pretty much has a good idea. The bond market's always looking ahead at what the Fed is going to do. So interest rates have been coming down because the bond market is anticipating the Fed is going to lower that interest rate on the prime rate. So the bond market is watching these things, watching these economic reports in real time and responding accordingly on a day-by-day, even hour-by-hour basis. And that's the value of mortgage-backed securities increasing and decreasing throughout any given day. The Fed meets every other month or so throughout the year, and then they determine that prime rate. So that's a little bit about that. Feel free to reach out anytime with questions, and look forward to talking with you. Talk to you soon.